Well, Phil, the ongoing EU debt crisis has certainly led to increased volatility on Wall Street in the past 2 months. Stocks are still up for the year, but the S&P 500 did give up 3.3% in the second quarter. Now, earlier I spoke to Goldman Sachs' legendary investment strategist, Abby Joseph Cohen, and I asked her if she thinks that the worst news has already been anticipated by investors.
Right now, we are at the brink of getting new information. We're waiting to see, for example, what the next phase will be in terms of what the European governments and the ECB decide to do with regard to those banks and those sovereign governments. Secondly, we're at the beginning of the U.S. earnings season for the second quarter. And third, and I think perhaps most importantly, we are seeing economic data, not just from the United States, but around the world, that is sending mixed signals. In some cases, the data suggest a slow growth trajectory, but in other cases, it suggests a deceleration, and that's what has investors worried.
Well, you mentioned the earnings season that's kicked off with Alcoa's earnings, which slightly beat expectations, but the overall forecast is for a pretty dismal second quarter. What is your outlook?
Keep in mind that U.S. multinational companies derive 40 to 45% of their revenues from outside the United States, even though total trade is only about 15% of our GDP. So these are the companies that are really affected for both good and bad based upon what's happening in the rest of the world. The big concern right now is the slowdown in Europe and, to a lesser extent, the deceleration in Asia.
What is the Goldman Sachs strategy for dealing with Europe?
We obviously watch this very closely, mainly out of our teams in London. We believe that the Eurozone stays together. We believe that economic growth in Europe will be slow, but we do not think it will dramatically worsen from these levels. And when we take a look at the equity markets there, we see stocks that are pricing in a very gloomy scenario. In many of the European equity markets, for example, the price-earnings ratios are about 8 or 10 times earnings, which is dramatically below the average over the last several decades. And the dividend yield on the stocks is dramatically above what we've seen in the past. So these securities look inexpensive. The question becomes, when will they actually start to recover? It may very well be before the economy there begins to pick up.
So you've said that you believe that the worst may be over for Europe and the equities look inexpensive. Is this perhaps an opportunity then at this stage?
We think the opportunities could be terrific for those people who have the staying power. They can look through the volatility and recognize that on the other side, these returns will be quite good. But you have to be willing to stick with it.
You mentioned that another concern is the Asian growth slowdown. Are there any sectors in that market that you are particularly interested in, that you see opportunity in?
So much of the slowdown, the deceleration in economic activity in Asia has also been linked to what's been happening in Europe. Mm-hmm. So it tends to be lower cost manufactured goods that have been under the most pressure. What we're watching very carefully right now, however, is whether in fact there's a slowdown in domestic economic activity in nations like China. If that is the case, then this can turn out to be something that is longer lasting in duration. And of course, we do see that the Chinese central bank has already stepped in to lower interest rates and to provide some stimulus to the domestic economy.
Any particular sectors within China that you find interesting then?
Some of the exporters on the industrial side and those that are linked to technology exports in particular. What we see around the world is that many technology products are facing good demand. In fact, stronger demand than you would expect given the level of economic activity. And so that's where our focus has been.
Well, let's bring our focus back to the U.S. and, of course, concerns about the economy, and talk about QE3, quantitative easing 3. Is that being factored into any of Goldman Sachs models? Do you think we're going to get QE3?
Right now, we think that we are at a point where the Fed could decide to move ahead, but they, like us, are waiting for additional information on how the real economy is performing.
Given the whole economic picture of the U.S., what are the sectors that Goldman Sachs sees as having the most upside?
They include technology, aircraft and avionics, not just computer hardware, but computer software and applications, entertainment and media. A good deal of the climate initiatives underway in the world are happening right here in the United States. And we think one of the most important things is to turn all of this interesting basic research into truly commercial applications. We think that is probably the ticket for good economic growth over the next decade or two.
And Abby Joseph Cohen says that Goldman Sachs' target for the S&P 500 by the end of the year is 1350.